In October 9th, 2007, it was not a bear market. In fact, it was an all-time closing high. How do we protect ourselves in a situation if it were to happen again? Volatility is reaching to its lowest level that we haven't seen since just the start of the pandemic, closing in on that gap. The Q's putting in a very similar structure that it did going into 2022. All that and more on today's Stock Market Brief Show, people, where we navigate the financial markets through the lens of technical and intermarket analysis. Let's get into it. All right, people, welcome back to the show. Sorry if my phone or microphone is still a little echoey in an empty office, still as it stands while I'm trying to put things together. So we had core inflation data come out today. Inflation numbers reported. Not much of a difference, but I will state that the core inflation number, right, we're trying to get that down to 2%. That's the Fed's goal, and we're still floating around the 4% marker. The S&P 500 literally is just driving higher in that positive gamma territory. The VIX did close that gap that we have not seen since early 2020, right before we saw that volatility spike. Does that mean if that gap got filled, are we going to eventually see the gap up at 45 filled back there from 2020 as well? Back month, first front month volatility is reaching out to another high over here. It's now 23% above front month VIX. Going into tomorrow, we have PPI data and we have the Fed interest rate decision. Most important, most likely, will be the Fed press conference, because we really kind of have an idea of what the Fed is going to be doing based off of Fed funds futures, and that is to keep the rates where they are. So it's going to be important to watch how the probabilities going forward look. Is the Fed going to put the kibosh to this rate cut where they're going to start pricing in back to hold rates higher for longer? Or is the Fed going to give us more dovish type guidance where the market's doing the correct thing? Now, if we are going into a rate cutting cycle, there are some interesting charts I want to point out. This is one I share very frequently, the monthly chart on the SPX. And you can see as rates are up, I want to point out when they start going down, when they start going down, when they start going down, and what happens right there at the 10-year, 2-year curve. It uninverts, rates go down, it uninverts, rates go down, uninverts, potentially rates go down. And that was when we saw those big movements. So we've been talking about 2008 on the beginning of this, so we'll go over this one in a little bit more detail. But I will point out what Michael Guy had posted on Twitter. He had stated that the market is rallying because of Fed cut expectations. That's in his quote. Now, a Fed cut marks the end of an expansion and historically results in a deep stock market drawdown afterwards. If you believe a Fed pivot is coming, you agree with me on a credit event. So are we about to see a credit event in the near future? And is that what the futures market is pricing in? Well, we don't know for sure. I don't know if you'd want to start placing bets because of it, but as long as we understand what's going on with the structure of the markets, it could benefit us in the coming days, weeks, months, potentially year, we don't know. Now, I posted this out on Twitter, just highlighting that in October 9th, 2007, right? Everyone was stating, yeah, see, nothing's wrong here, right? It's a bull market. We just reached an all-time high. But understand that after that day, those highs were not revisited till March 28th, 2013. And that's when we started going into the great financial crisis. Now, as Ernest Hemingway wrote in his novel, The Sun Also Rises, how did you go bankrupt? Bill asked. 2 ways, Mike said, gradually and then suddenly. So understand that risk too can escalate in a similar fashion. That's why we need to focus so much on risk. One way to do that is really be honing in on that 5-day moving average. Now, this is dating back into 2008, when right before we saw the crash, right? So that was the all-time high. Everything's all good. And then we saw this bear flag form. Now, the reason why I'm showing you this is because this is how we can get a little bit more tactical in the market when we do eventually get a break of the 5-day moving average. And remember, this is the 32-period moving average on the 60-minute time frame, so it's not quite the 5-day moving average because I couldn't pull the 65-minute chart up to get it more even, but it's good enough for this explanation. So I wanted to call out, once we broke it, what's the 5-day moving average doing? It's really just flattening out right here, and then it started turning down. Now, when the market starts to turn down, or when the 5-day moving average starts to decline, that means the short-term trend equals bearish, right? And that's where we want to be a little bit more careful. And look is what happened. Well, we came back up. We tried to touch. We tried to come back up. We broke down. We tried to come back up right over here. And it was still declining at that time. So this, after a large move, you might get excited. But what happened? Well, we got rejected. It's not until we start turning the corner here where we went back up, we pulled back down, and we got up when we started to see the pop up higher. Okay, look what happened. We broke down. It was still inclining. So you want to be cautious. So I waited to push this percent down while it started to turn back around. And you can see it was declining. We poked our head above it, but be cautious there because it's still declining. Boom, we cracked back down. Then over here was neutral. Okay, we tried to run it a couple of times while it was still declining. And it wasn't until here where it started turning back up. We flagged, boom, we started to rally again. So this is why I point the 5-day moving average out so frequently, is because if you're aware of its position, if it's inclining, if it's neutral, if it's declining, that will help you guide the market direction. Remember, like this was a 5% drop in the market. This was a 5.8. This is 3.8, roughly, right? 4.4. And this one over here, right? After all this chop, this still from peak, well, from breaking down over here to the trough of 2008 was 14.4%. Okay, so we'll get a little bit more into that now, looking at the SPX chart of where we currently stand on the 30-minute time frame. As we kind of listfully drive up higher, we close the day just roughly around the daily expected move and that call wall that we were pointing out, that 4650. Now 4700, that thing is growing at 208 million. So this is going to be the larger call wall to pay attention to, obviously going into the remainder of this week. The weekly expected move was actually not tagged yet, but going into tomorrow, we have the 4672 upper daily expected move, and that's right there in line with the upper weekly expected move. I still expect us to either tag one of these weekly expected moves. It's been 2 weeks since we haven't hit it. So if we go a third week, the next week is going to be most likely a for sure, but it's very rare nonetheless to not hit it for 2 weeks in a row. Now we are above a rising 5-day moving average and we're above positive gamma territory. So that is both bullish once again. So yes, the likelihood is we go higher, but pay attention to where we came from. So you always want to ask, okay, well, if we go higher, but where did we come from today? Well, we saw a little bit of a pullback, positive gamma territory, right? We sell strength, buy weakness. Boom. We started moving higher to where that upper channel when we haven't seen much of a consolidation. So this isn't necessarily the places I'd chase. Imagine if we gap up like we have in the prior, like for example, right here, we gapped up. And if you FOMO'd into this, not knowing, hey, like it's getting extended, boom, we kind of completely sold off right there, right? Yeah, it recovered. But just understand that if we gap up into these key levels, these gamma levels, perhaps price comes back down and you don't want to catch yourself in a move like that. So perhaps you're long and you want to take a little bit of profit off, or, it just depends on your time frame and how you're approaching the markets. But 4,700 is going to be the bigger level. Then we have the weekly and daily expected moves that yet to be tagged. The lower daily is over there at 4,615, and we're still within this range structure, right? It's still higher highs, higher lows, drifting up a little bit higher, getting a little frothy up here. But we shall see the gamma flip level is at 4,560, so we're still in positive gamma territory. That lifted up slightly there. We'll take a look at the SPY 30-minute time frame here too. I think I said 15-minute. This is the 30-minute time frame, sorry. SPY on the 30-minute time frame. If you want to download this chart deck, just go ahead and download it and you'll get these levels. I'm not going to go through all of them. I have the 2 standard deviation moves going into tomorrow, the daily expected moves, and then the weekly expected moves here too as well. We're above a week-to-date anchored VWAP. That's inclining. We're above a month-to-date anchored VWAP, and that is turning up there too as well. So all quite bullish in this environment. I will note once again, RSI is a little bit frothy right here as price. If you ask where it came from, it's been a straight direction. So you really want to see some kind of consolidation versus kind of FOMOing into the price action. Now the Qs, I want to show you really quick here where we stand as far as the daily expected moves. Weekly expected moves is at the weekly upper is 399.59. And the reason why I'm showing you this once again is because the RSI here on big mega cap tech is getting overbought. We're above that rising 5-day moving average. Take a look how it was declining. All right. We were below it, so it's bearish. That's more of a bearish. I mean, if you look to the left, it's really kind of just neutral. But in the short term, it was declining. And where did we gap right above? Well, we started the trading session right back above it, and then we started pulling back down. But guess what? As it started moving down, we were above a month-to-day anchor VWAP. This started back to inclining phase again, and then we really had that takeoff today. Now, I do want to point out that I thought was interesting is the upper weekly expected move was actually tagged in the aftermarket trading session. I personally like it when it's tagged during the live trading session, but in the post-market trading session, we actually did come up here to tag that. So if the S&P 500 wants to continue and rip up into these levels, it's going to have to see most likely big tech to break through and come into that daily expected move. We're not too far off from that all-time high there too as well. Here's an interesting chart on the Qs while we're talking about it I found this one on Twitter, Gladiator Research, and they pointed out on the 4-hour time frame, they said, well, I forget what they said. They just said a quick statement, but I'll walk you through it. It was kind of a cool thing to spot. But you can see here, going into 2022, which was the start of the bear market, we saw actually a 16.5% rally that lasted for roughly 49 days, okay? And then we had that negative divergence. And now, right now, what did we just recently see in the month of November? One massive rally, very similar to the structure of what we just saw here, that went up, 16.47% in about 50 trading days, 47, and it has that negative RSI divergence there as well. Now, I want to call out that the negative divergence, right, it has to turn back down. As it stands right now, it's building, but it's still pointing up, so you want to see this curl back down, and you never know. Maybe we get a similar situation, maybe we don't, but as it stands, right, we have a high, a lower high, and then that changed when we started getting this low, and now we have a higher high and we have that higher low there. But that's pretty much the only really low that we have to grasp on. So if we start breaking back down from that, then maybe we come test a little bit lower, right around that 370 marker. But as it stands right now, the negative divergence is building, and the structure, this isn't a prediction. It's just something kind of interesting to point out. That's all I got for you on today's episode, everybody. Hope it helps out. See you later.